First, we're going to start with looking at business entities. Just as a summary of business entities, we're going to start with sole proprietorship, partnership, LLCs, and within an LLC we have a single member and a partnership. We also have an S corporation and a C corporation and a nonprofit. So looking at the sole proprietorship, sole proprietors file a Schedule C with the 1040 on their tax return. It's a personal tax return. The Schedule C simply just records income and expenses on top of your regular personal 1040 taxes. Next, the business owner owns all the property in the business activity. So in a normal company, you have a balance sheet, whereas a sole proprietorship, there wouldn't be a balance sheet. Really, the money is exchangeable between the business and personal. The owner is responsible for all the debt. So again, it's a personal debt. Anything that you create as, say, a credit card, for example, that's all considered a personal debt. The owner receives all the profits. Any money coming in is 100% part of the owner's revenue. The business ends when the owner decides to stop business activity or in death. Now, the problem with the sole proprietorship is that there's no corporate veil to protect their personal assets. If you have a product, as an example, and you don't have insurances to protect any kind of faulty product, then your own assets, your house, if you have one, any kind of investments you have, those are all up for grabs for anybody suing you as an individual, because again, you're one and the same as your company. So there are a lot of legality issues that you do need to think about. Now, some people that are just more hobbyist, that might be something that a sole proprietorship can get away with, but and overall, it's probably the least desirable, and it also doesn't give you a lot of credibility if you're a sole proprietor to people that you're trying to do business with. The next is a partnership. A partnership files Form 1065, which is a partnership return. A business is owned by more than one individual. Some examples would be accounting firms, law firms, medical practices, and dental practices. Partnership agreement is signed up front that spells out, and you should make sure it does spell everything out, the duties and responsibilities of each partner, the amount each partner will contribute, both work, responsibilities, and finances, and the percentage of ownership of each partner, as well as the share of profits for each partner. Now, when you have a partnership, you have to keep in mind that it's very similar to like a marriage. And if you do not really understand how each other operates, and you don't have all of these legalities spelled out in a partnership contract, things can get bad really fast. In my experience of over 16 years, I have seen a lot of friendships go away, a lot of family membership relationships dissolve because there wasn't the proper contracts put in place, any kind of buyout agreement. All of that should be spelled out. I definitely recommend in any business scenario where you're not the only owner that you do get legal advice and have impartial legal advice so that both of you can come together, or multiple of you can come together and have a mutual agreement and understanding through the life of a company. Next is a limited liability corporation, also known as an LLC. There are two types of LLCs. You have a single member LLC, which also files a Schedule C. It's very much like a sole proprietor. And in fact, instead of being a sole proprietor, my recommendation would be to consider an LLC single member. You still file the same tax returns, but it does give you more protection as long as you have this segregation between your personal and your business functionality. So that's the key thing to separating not only having a sole proprietorship versus actually a company entity set up, but also making sure that your personal finances are completely separate from your business activity. Very, very important. Next, the second part of the LLC, or the second type of LLC, is a partnership, which also does file a 1065. So again, you're giving more credibility, you have a corporate veil of protection, and you're still filing the same types of tax returns. So what does the word limited mean? Well, the limited means that you have, again, you have some protection over your company as long as you keep your information from personal and business completely separate. So corporation is the next one. Now there's corporation and then there's S corporation. On the S corporation, you file a Form 1120-S, and that has pass-through taxation. The C corporation files just an 1120, and it does not have a pass-through taxation. So that is the only corporation, or that's the only entity that actually pays for their own taxes. Whereas if you have an S corporation that files the 1120-S, however many owners are in that business, whatever the net income is for that company, it's divided between the owners based on their percentage of ownership. So for example, if you have $100,000 of net income on your income statement and you have two 50-50 partners, then each of you gets what's called a Schedule K-1 for that $50,000 net income. That $50,000 goes on your personal tax return as revenue. Likewise, when you have an an S corporation, then if you have a loss, it's equally distributed amongst your percentage of ownership to that corporation. Now, when you have an LLC, the LLC is a little bit different, and it's actually a little bit of a benefit. Let's say you have two owners, and you technically are both 50-50. In your agreement between each other, you may be somebody that has the option or opportunity to contribute more into the financial side of it, maybe more investment into the company because maybe you have more cash, and maybe you're putting a little bit more work into the company. Well, in your contract, you can have where you can designate a percentage of ownership or percentage of loss, I should say, or a percentage of income based on that year's contribution itself. For example, let's say you originally are 50-50 partnerships on an LLC, and you decide to put in an extra $100,000 to infuse into the company. Well, in your agreement, you could have where at the end of that year, if you've contributed $100,000 and they've not contributed anything, maybe you take 100% of the losses that year. That's the nice thing about an LLC, that you can do that. You can change your claimed percentage of ownership in your tax returns year to year. Whereas an S corporation, you can't do that. If it's 50-50 for that year, it's 50-50, and you have to distribute evenly the 50-50. I've seen that run into a lot of problems with businesses where they are incorporated, and they do run into that where one business owner does have to contribute more in time and money, but they only get the same amount of deduction or loss, or they have to split the revenue between the partnerships based on their percentage of ownership. So talk to your CPA or your attorney about the differences, and get the right one for you and your scenario. So continuing back on the corporations, the corporations have a legal right to do business in its own name. They must get permission from the state to operate. And it has a legal right to own property. Now, some advantages and disadvantages of an S corporation. Some of the advantages are, with proper accounting, your corporate offices are protected. And again, there's pass-through taxation to the owners. On the disadvantages, if you have more than one owner, your percentage of ownership is fixed and can't be changed year to year based on contributions, which is what I just talked about. So again, the difference between an S corporation and an LLC is that at LLC you can fluctuate that percentage of, and it's not necessarily changing the percentage of ownership based on your agreement, but you can have an amendment in your agreement to say if an owner contributes more financially or more labor, that can be adjusted year to year on your tax return only. So that's something that you can definitely talk to your CPA about. And your attorney to make sure that's in your contract. And then the disadvantages, again, is that each owner is equally distributed to the percentage of ownership. I actually have a client where this gentleman brought his son in as a part owner, and he doesn't really do anything, but he's 8% owner. And at the end of the year, because they're incorporated, his wife, although his wife is, I think, 30-something% owner, although she's contributing a lot of the money, his son from a different family is getting that deduction as an expense. So she's putting in all the money, but because they're an S corporation and they're evenly distributed based on their percentage of ownership, she doesn't get that deduction. So he gets a big return and she doesn't. So that's just something that you need to think about before you decide what entity type you are. And you can always change your entity type now that you've learned a little bit more about them. Now, some advantages of a C corporation. A C corporation can live beyond its founder. So a lot of big corporations, we're talking to major Fortune 500 companies, those are corporations. They have board of directors, and they have and they outlive beyond any founder, so it doesn't dissolve when the founder goes away. The shareholders are not responsible or liable for debts and taxes in the corporation. The most of the shareholder can lose is the value of their investment. So whatever they purchased, whatever they bought into the company and bought shares, that's what they lose as value, or any other investment they made, any other contribution they may have made. A business entity is separate from the owners. And the owners is presented with shares of stock and has board members as well as officers. So the board member determines the direction of the way the company is going. They usually meet hopefully once a month to go over the financials. Some board members meet on a quarterly basis, but these meetings are documented. Even in an S corporation, these meetings are documented, and minutes are taken as part of the corporate binder. The last but not least is the nonprofit. The nonprofit, we're not going to spend a lot of time about, but it does file a 990 form. And there are other requirements, exemption requirements that you're required to have. And I have a link here that you can always go to. It's an IRS link, and it tells you a little bit more about a nonprofit. And that concludes business entities.